Pin. All right, let's get in Sunil Subramaniam. He's Chief Executive Officer at Sundaram Mutual Fund. Mr. Subramaniam, thank you very much for your time. Good to have you here. How's the market doing, and how's the market treating you, rather, as a fund house? I mean, investors are treating you very well. They're handing you lots of money, pots of money, month after month. But how's the market treating you?
I think the market has been kind of mixed. I think we've seen months where the market's risen, markets fallen. I think on a one-year basis, large caps have delivered, from an index perspective, just 2 to 3%. But mid caps have done better, strong double-digit growth. And I think the important thing is the markets have not been so bad as to frighten retail investors away. So what we've seen, for example, over the last year is something like a 10% growth in our retail investor base. I'm talking about growth over the base. That's one. Second is, if you look at the redemptions are down 40% on an annualized basis, but sales are up 100%. So what we are seeing here, I think, despite the recent, ECG-like movement of the market, is the maturing of the investor, that he's able to back a longer-term view and not run away just because there are a lot of negative news flows, political-related, happenings. So I think that maturing of the investor, what we are seeing, I think, is a very healthy thing for the Indian market.
I think, are we jumping the gun a little bit? Because you've been in the market a long time, but over my 10 years, I've heard this phrase, the investor is finally maturing, many times. But but it never quite pans out that way. When when markets really get into trouble, well, people head for the exits.
Correct. The reason I'm making that statement, Shant, is the fact that what we have seen, this rise in the flows, is on the back of a 250% rise in SIP flows.
Yes.
So the re-entry of the scared retail investor who ran away after 2007-8 and then the crash that followed has come back in the form of systematically entering the market. So what is happening is that bad news, when it affects market valuations, don't affect their portfolios as much. So the maturing may not be as much a mental change as much as the manner in which they have entered the markets this time. So I think the fact that they're willing to look at SIPs and longer term SIPs is where the maturity indicates. It's not that they know more about the market and are being smart, saying, "Nahi, abhi bhagna nahi hai." Not that way. But I think for a retail guy, always SIP is the best route to enter the market. He can't go based on news flows and what the channels tell him about, what to enter. So I think that behavioral pattern, that look, I don't know enough about the market, but I know long term it's a wealth creating asset class. And so I need to gradually enter. That is a trend which I'm more focusing on.
Okay. Just those numbers again, you said your investor base has grown 10%.
Yeah, we were at about 11.3 lakh investors last March, and we are at 12.4 lakh now.
Okay.
So which, this is 11 base over our 20-year existence, right? And that base itself has shot up 10% in a year, means that there's a lot of people coming back into the market. So
out of this increase, how many of these new people who've come to you have come to you for SIPs?
In terms of number, that number would be about 35%. Okay. Right. In terms of value, it will be much lower because lump sums naturally kick in much better, whereas SIPs add up over a period of time.
Right. 35% is a meaningfully large number as a single way of getting into the market. Just one question. So, volatility has been low here. Globally, volatility has been very low for a while. When volatility levels are extremely low and things are looking good, that's the time to actually start worrying a little bit about what's coming. Because volatility levels across the world have been low for a long time now. That's the point I'm making, especially in the developed markets, US, for example. Are you sensing any trouble on the horizon? Because we've seen glimpses of this: China, US markets, specific sectors in the US, healthcare, for example, taking a big tumble. Are you sanguine and pretty confident that, this is essentially an global environment where growth is going to be lower for longer, but nothing is going to break? Is that the way to look at it?
I'd like to slightly distinguish markets from economies, right? So markets have been less volatile Because of two things. One is the economic trend has been clear that growth is quite far away and inflation is low, right? So when the trend is clear, whether it's a rising trend or a falling trend, the trend is clear, then volatility will be low because you only bet on uncertainty, right? When it's certain that economy is not going to grow, why will there be vol? That's one. Second thing is that if you look at the next few months, right?
No, okay, let me just come in there. But the point also is when growth is low for a long period and the assumption is that growth is not going to happen for a long time, markets should reflect that. Markets aren't reflecting that. So in that sense, this is a new type of situation we have been in for the last few years. And that's thanks to central banks or whatever. I mean, we can get into that discussion separately. So this time, I completely agree. The relationship between the economy and markets are tenuous at best. But I mean, you know, it could be different because the normal rules have not applied over the last few years.
Okay, and again the answer is the same thing, right? If you just go down one level deeper, is that because growth is low, market people are confident that a QE system will continue. So that liquidity is what has propped up the markets. And since growth is expected to be low, they don't expect the QE tap to be turned off. So it's again the uncertainty versus the QE tap. So that economic uncertainty is relating, economic certainty of no growth is leading to a greater certainty of QE flows continuing or not tapering off, which then says that if the liquidity is going to be there, then, and why does volatility come? Because there are bears fighting against bulls. So if they know liquidity is coming, the bears are going to keep quiet, right? Only when the liquidity tap looks like getting shut, right? When growth is, say, on the verge of coming back. Now, US keeps showing that like a hide and seek play. But when Europe and Japan and larger economies start showing a revival to growth, you will actually see uncertainty in the markets. And that time you will turn around and ask me, when the outlook is so good happening, why are the markets becoming volatile? Because then they are not sure, is Japan going to turn off QE first or Europe is going to turn it off? So the uncertainty at play is what's
actually only the next step from both the countries, both the regions is going to be increase in QE, not decrease.
So,
I mean, Japan, the central bank meeting was on Friday, a lot of chatter that they might expand their balance sheet again. ECB last week saying December will maybe do more. So there's more, not less.
The only uncertainty is from the US. Otherwise, the other two, it's fairly certain that growth is not returning. So I think that's the answer. The right answer is, the fact is that global growth is on a down and a weak trend. There are pockets of growth. India is one, clearly a pocket. US sometime or other will definitely revive. So I think these pockets of growth are there, but overall, if you see the World Bank thing, that the world GDP growth rate is going to be on a softer trend, and hence the QE trend will keep the bears at check. So the uncertainty.
Someone was saying, I don't know, I think I read it somewhere, said the fully invested bear has done very well over the last few years. I mean.
Correct. For the wrong reasons.
For the wrong reasons. Okay, let's just come back here for a quick bit. What's your research team telling you? You got a very active research unit at Sundaram. What is their assessment of the earnings season so far?
Okay, I think the earnings season has been roughly similar to the last quarter. That is, the first results which came out were very good. I think we saw about 8% in the first week of the earnings, and then it tapered down because the commodity and the metals kind of players come in later with the earnings, right? So I think that this quarter is going to end with a 3 to 4% kind of a growth only. So it is going to be not very great, but I think that the two factors, that is even the commodity and metal majors, I think a lot of bad news is getting priced in increasingly. So, you know, Mark, it's not so much, the sequential profits may be down, but not as much down. That is, the slope of decrease will be less. That's one. Second is, market analysts also readjust their expectations down on these. So, coming quarters, you'll not see that much of a variance between analyst estimates of earnings, even in these sectors which are not doing well, as much as, in the quarters. So there will be a realistic assumption. The third thing is, of course, is that I think our analyst view is that there is still more downside to go on commodity, because China steel, as you know, the numbers came out pretty bad. So I think that it's going to be, while the market expectation will be toned down, there'll still be sequentially lower profits from the commodity metals pack. But that will is increasingly starting to feed positives into users of commodities and metals. So auto, which consumes steel, or power intensive.
We're seeing that in results.
Yeah, we've
Gross
seen that.
margins are expanding.
Exactly. So we expect that the next quarter should actually see a doubling of the earnings from 3 to 4 to about 8 to 10. And the last quarter, we actually expect double digit, definitely, or even going up to 13, 14. So our full year is that there should be a kind of 8 to 10% growth in full year profits. That's what we are seeing.
This is this year.
Yeah.
You're not talking about auto overall, right? 8
No,
to
I'm
10%?
talking about the overall pack. Not just auto.
Index 8 to 10% earnings.
8 to 8% to 10% is what we think, because the second half.
So I mean the sell side, which feeds you with information, is still higher than your own assumptions, right? I mean they're at 13, 14%.
Yeah, they're at 13, 14%.
Yeah.
We are a little more cautious in the short-term outlook on those things.
Yeah.
Right. So.
Okay, all right, fair enough. We'll leave it there. Mr. Subramaniam, thank you very much. Quick
Thanks.
chat. Appreciate you joining in
Right.
from our studios today.
Thanks, Sita.
Take a quick break here. We'll come back in 2. Surjit.